Bonds pretty quiet today, but for the most part has resumed their gains following the sell-off from about 3 weeks ago now. So what are you looking at right now?
Well, what I'm looking at now is top-tier data. I mean, let's keep in mind that Q3 is over. We've been trading in this range from 143 to 190 for at least 2 weeks, maybe 2.5 weeks, and it's getting old. And I think we have some, fairly big top-tier data coming up the first 2 weeks of October. And I think it's going to be a reset or a recasting of the narrative, whether it's up or down. I don't know.
So you look at the 10-year bond, and the sell-off that we had just looks nothing more than like a little bounce to the mean of the trend, right? If you look just to where we began this the rallying again, it looks like, hey, we just pulled back into the line and now we're on the move. But Larry, the data that's on the way, I'm with you, is going to be big. But the data we've had though has also been a lot better than expectations. Is it just not nominally strong enough to keep those bond sellers active?
Yeah, no, I think it's we need more consistency in the numbers, and especially the top tier numbers. I mean, ISM on Tuesday, big deal. I mean, you have manufacturing as close as contraction as you can get, and I think it's how people interpret that data. If we stay around 50, are we just resetting at a low level or low plateau, or is it going to tumble further? Non-manufacturing has fallen 3 out of the last 4 months, so that matters. And then there's a conundrum of jobs versus inflation. So the 6-month average for jobless claims, the lowest it's been since 2012. It's still sustainable, still good. And I think those two numbers themselves could really recast a vision for the next move in the market.
So, Larry, then is it just buying the long bond? Is it a resumption of trend? Is it that simple? Tell me where you're looking for trading opportunity in the market.
Well, I'm going to wait to see how these numbers turn out. I'm not going to get in front of them. I'd like to see, watching the 2.5 right now, the 2.5 spread, not that I'm trading it, but it's still inverted, and I think that's problematic to the market. So I think how that spread reacts to this data will be telling, at least for me, on how to trade a 10-year or the long bond, 30-year.
So, Larry, when you think about the Fed's role in this market now, the expectations that by the January meeting we get another cut are still there, right, at about 100%. But whether it comes next month or the month after is a little bit more of an unknown than the previous 2 cuts in which the market was screaming that it needs them now. How does that change the dynamic here for the bond market? Does it introduce the possibility that perhaps we have to wait longer for that next cut? How does that play into this?
Yeah, I think they're holding on to the tools as much as they can, and it could be something different, something other than a rate cut. Face it, it's a conundrum when you have such a division between inflation and wages. So there's a lot of news and consensus definitely percolating about that 75 basis point cut and pause. However, there might be something in their back pocket that would resemble a rate cut, but would not be a rate cut to help extend the economic cycle.
So tell me about that. Are we talking possible more than organic balance sheet expansion? That was the buzzword that was used last time.
Yeah, absolutely. IOER, ways of expanding the balance sheet. I mean, we saw what happened to refi rates and just in the last couple of weeks, how volatile that has been. So I think that's more the issue, because the lesson was, we saw that before as they were raising rates. You could see how quickly the financial system tightened, and they just don't want that to happen. And so perhaps instead of a rate cut, they get into an alternative method to help the balance sheet.
So, Larry, if we take this again from the high level, last point here to put this together is, as the bond market, as yields dropped from 2.4 back down to 2.1 where we are now after that sell-off at the beginning of September, The trend for the data hasn't dramatically changed too much, still for the most part coming in better than expected. What's definitely has been happening are headlines around political crisis, either here now or in the UK around Brexit, or if it's escalation of rumors around China trade. So is this becoming more of like a geopolitical bid the last couple of weeks in your mind?
Yeah, no, I do think so. Also, I just always rely on what's going on with rates around the world. When you think of JGBs, when you think of Boone and Gilt, the spread between them and us can only get so wide. And so with that in mind, we're following them to a large degree. I mean, not totally, but that's where the trend is going. And so even though our data has perked up a little bit, I think the market is just wondering if this is just, are we stabilizing at a lower level, so therefore bond yields should be lower, or is there something else at work? But unless we see like a systematic economic recovery, we're going to see rates artificially low just because of what's going on around the world.